What's up, guys? It's Rob here, and today we've got to make a video about what is going on with the stock market, right? Stocks are absolutely crashing today. The S&P is moving down pretty dramatically. Powell has said some pretty scary stuff for the markets, and they're reacting rather poorly to it. We've also got to talk about what should we be doing when we hear this kind of stuff. What's happened in the past when the same kind of things have happened, and what has that caused for the market to do, right? What has the market done in reaction to that? So first off, you can see currently the market is moving down pretty dramatically. In fact, from the highs of today to where we're at now, we're down almost 2.5%. And that's not even in an entire 24-hour cycle. So we've just been on a straight shot down today. It's not looking good at all for the markets. The S&P is having a pretty red day today. Nobody's too happy to see it. Now, a lot of this has to do with Powell, okay? He says that taming inflation is absolutely essential and that a 50 basis point hike is possible for May. So that's really what's got investors stirred up, right? They're very worried that we're going to see a 50 basis point hike in May. Now, we're going to talk about that a little bit later and why that's not as big of a deal as some people might think. But we've got to talk about what Powell said in this meeting that he had today, right? He said that first off, a 50-point basis hike might be possible for May. He wants to see actual progress on inflation, and so far he's been disappointed with what he's seen, and as he should be, right? This is the chart for inflation over the past year, and you can see it's basically just going straight up, right? We're just seeing more and more inflation, exactly as we expected. I mean, what else can you expect when the government prints so much money over the course of just a couple of years, right? You're obviously going to see massive amounts of inflation. The Fed was never right when they were saying that inflation was going to be transitory. It's just been shooting straight up as soon as they started printing all of that money, right? This is no surprise. Apparently, it's a surprise to Powell, and he's disappointed with the inflation that we're seeing, but it should be no disappointment, right? He should have expected to see this, and potentially he has and just hasn't told us the truth. But even Elon Musk is disappointed with inflation. He thinks that inflation is actually worse than reported and likely to continue through 2022. He said that some of his suppliers are requesting 20 to 30% cost increases for parts, and that's much higher than the 8.5% inflation reading that we've gotten so far. Now, we obviously know the PPI, the producer price inflation, is up a little bit more than this. It's up around 12% at this point. But consumers are currently supposedly paying about 8.5% more, not counting a lot of things like real estate, right, and other assets. So the real scary thing that Powell has said, the thing that actually has me worried, is that there might be a world of higher inflation, obviously, and it's clear that globalization has slowed and may go in reverse. That last part is very important for the United States. The fact that globalization has slowed and may go in reverse. Now, we've already heard about this to some extent with the supply chain issues, but Powell is saying that trade is in reverse due to energy supply problems and potentially other problems, right? Obviously, we've had large trade deficits for many, many years. We've racked up a massive national debt. Just in 2021 alone, here's a list of the deficits that we've had, the trade deficits with some countries. With China, we had a $355 billion trade deficit, $100 billion with Mexico, $91 with Vietnam, $70 billion with Germany, $60 billion with Japan, $60 billion with Ireland, $50 billion with Canada, $40 billion with Malaysia, Taiwan, $39 billion with Italy, totaling for just the top 10 countries that we trade with about $915 billion worth of trade deficit. Now, trade deficit, for those of you who aren't aware, is essentially the difference in the goods that we send out of the country and the goods that we take into the country. So that's essentially saying that we're taking in about $915 billion worth of more goods than we send out, right? We're basically racking up a big deficit, basically taking out more debt than we're making. We're basically taking out more debt than income we're producing via trade at the very least, right? And that's essentially like taking out debt on a credit card when your income just isn't high enough to actually pay for stuff with cash. Now, that's not exactly how it works. That's a bit of an oversimplification, but that's essentially what's going on here, right? We're essentially just sending out cash to these countries. Oftentimes, the cash has just been printed. The cash has been borrowed. That's why we have such a massive national deficit. And unfortunately, this shows no signs of slowing down. Now, it has actually slowed down, not due to a lack of our demand for these goods, but due to a lack of supply. That's why we've had these supply chain issues for the past while. And it's looking like this may actually slow down even more. Now, when that slows down, when there are less goods coming into the country, and there's the same amount of demand, right? People still want all of that stuff. That's when we're going to start seeing real big upticks in inflation, right? As people want to buy the same amount of goods and maintain the same quality of life, the same lifestyles that they've had, and there just aren't as many goods coming into the countries, right? We're not producing as many goods here as we did tens of years ago. and other countries are now going to start slowing down what they're sending to us, we're going to see prices go up because people are going to have to start essentially bidding wars to get the goods that they want, right? We're going to see rising costs. So that's an unfortunate side effect of this slowing globalization, which inevitably you can't just keep borrowing money left and right and having massive trade deficits forever. Obviously, this had to come to an end at some point. It's not looking like it's going to be a great situation for the United States dollar, right? We're going to probably essentially be bidding against each other in order to get the goods that we want in the next couple of years. That could be the case. It's not guaranteed, but if we do see a big slowdown in globalization, then that will probably happen. It's not looking like the brightest situation at this point. Now, in terms of what's going on with the stock market and where assets are going, and what I would or would not be doing, I certainly wouldn't want to be getting rid of cash. And here's a reason why, right? You can see the inflation rate right now. You can see that we are currently spiking up inflation-wise, and we haven't had a spike this big since just about the 80s. So we're going to use that as kind of a guide to figure out what might be going on with inflation and the stock market and all kinds of assets, right? Gold and silver, you could extrapolate this to that. But if you actually look at the S&P's historical returns, you can see that the 1980s were a fairly good decade, right? We had some green years. We had green 1979, up 12%, then up 25% in 1980. Then 1981, when inflation peaked, we actually had a red year, down 9.73%, all right? So inflation did peak right around 1981, and then we did actually have a red year in the stock market. Now, the Fed countered this, right? They countered this massive drive up in inflation with the federal funds rate, and they raised that in 1981 to about 19%. It was pretty darn high up there in 1981, 19%. Now we're talking about rate hikes that could possibly be going to 2, 3, 4, maybe 5% right now. You can obviously see we've fallen quite dramatically since the 80s. We don't have rates that are nearly as high as they were in the 80s. Yet despite having rates that high in the 80s, you can actually see the historical returns. Way back in 1981, we had a red year, and then that was followed by 8 years of green and gains in the S&P 500 until we had another red year, down 6.5% in 1990. So despite massive inflation during the beginning of the 80s and huge federal funds rates, right? We saw massive federal funds rates. The stock market did not actually end up crashing all of that much, right? The stock market and assets actually performed relatively well. What did take a hit was actually the dollar. You can see the dollar pretty much since the 1700s has just been on a straight shot down, right? There's been relatively few times when the dollar's been increasing in value. It has happened in the past, but the dollar has basically just been tanking since the 1700s and in the 80s included, right? The 80s, it just continued to tank, right? It actually looks like it accelerated how much it was tanking when we saw all of that inflation and all of those rate hikes. So in my best guess scenario, I would be guessing that we'll probably see something similar. We'll probably see assets perform well. We probably won't see the dollar perform well. And so in my opinion, this whole stock market sell-off doesn't make too much sense, and it's not something that I want to be partaking in. I don't actually want to be selling my stocks and collecting cash and holding cash in a time when we're probably going to be seeing big inflation. We're probably going to be seeing some rate hikes, and we're probably going to be seeing the dollar lose value. My guess would be we'll probably see stocks and assets such as gold, silver, real estate, crypto even, gain value, right? That would be my expectation based off what we've seen in the past and just the fundamentals of how things work, right? If you're seeing high inflation numbers, it doesn't make too much sense to me to be flocking to cash because the inflation is measured in cash, right? The inflation numbers are actually how much your cash is losing value, not how much your assets are losing value. And obviously, it's not great to have a high inflationary environment. That's not the best for some companies. We saw Elon Musk was paying about 20 to 30% more for some of the Tesla parts that he needs to make his cars. But I would still much rather hold a company that is profitable than be holding cash that's just perpetually losing value. So that's just my opinion on the situation. Obviously, not financial advice. And if you guys appreciate the video, feel free to subscribe to the channel. And other than that, guys, I'll see you in the next one. Have a great day.